Regulatory framework for IFSC listings. Have you ever wondered how companies can list directly on international exchanges from India? Let's take a closer look at the regulatory framework that makes this possible. The International Financial Services Centres Authority (IFSCA) was established in 2019 under the IFSCA Act to oversee all international financial services in India's IFSCs, such as GIFT City. The IFSCA is a unified regulator of financial products, institutions, and services within these centers. It combines the powers of key regulatory bodies like the RBI, Reserve Bank of India, SEBI, Securities and Exchange Board of India, IRDAI, Insurance Regulatory and Development Authority of India, and PFRDA, Pension Fund Regulatory and Development Authorities. This consolidation of regulatory power simplifies the process for companies that previously had to navigate a complex web of rules. Let's explore how this unified structure allows businesses to raise capital directly on global exchanges. Overview of the IFSCA Act 2019. What's the foundation of all this? It's the IFSCA Act 2019. This act grants the IFSCA extensive powers to regulate financial institutions, products, and services, ensuring that Indian companies are compliant with both domestic and international financial standards when raising capitals abroad. The IFSCA oversees key areas like banking and non-banking financial services, capital market activities like listing and trading of securities, insurance services, investment and fund management, and pension services. By aligning Indian financial regulations with international standards, the IFSCA helps companies issue shares in foreign currencies, giving them access to a larger pool of global investors. Interested in how IFSCA makes the process easier? Stick around because we are about to dive deeper. Significance of direct listing for Indian companies. Let's talk about why direct listing is a game changer. In the past, Indian companies had to rely on methods like depository receipts, ADRs, GDRs to raise international capital. But these processes were time-consuming and expensive. Now with direct listing, Indian companies can list their equity shares directly on international exchanges. What does this mean for your business? The benefits are clear. Global expansion. Access to larger pool of international investors, including institutional and private equity investors. Financial flexibility. Raise funds in major currencies like USD or Euro, reducing risks associated with currency volatility. Enhanced credibility. Listing on a prestigious global exchange boosts your company's credibility, leading to a higher valuation and more opportunities. Does your company aim for global expansion? Direct listing could be your fastest route to international markets. Let's explore how you can leverage it. Key exchanges in IFSC: India International Exchange and NSE International Exchange. Now that we have covered the benefits, where exactly can Indian companies list their shares? The two key exchanges facilitating direct listing in India's IFSC are the India International Exchange, India INX, and NSE International Exchange. These exchanges offer some major advantages for companies seeking global capital. They are foreign currency trading. Raise funds in foreign currencies like USD, Euro, GBP, reducing rupee volatility risks. Extended trading hours. These exchanges operate during extended hours to match global time zones, enhancing liquidity and making it easier for international investors to participate. Listing on these exchanges doesn't just provide access to global liquidity, it also ensures you benefit from robust regulatory oversight provided by the IFSCA. Sounds promising, right? Let's continue. Companies eligible for direct listing. Not every company can jump into direct listing. The LEAP rules, Listing of Equity Shares in Permissible Jurisdiction 2024, establishes specific criteria to ensure only financially sound companies can benefit from this opportunity. To be eligible, the companies have to be public companies only. Only public companies can list directly. Private companies must convert to public companies first. Compliance with Indian laws. Companies must follow Indian regulations, including the Companies Act 2013 and SEBI regulations, which are prescribed by IFSCA. Strong financial health. Companies must have a positive net worth with no outstanding public deposits or defaulted loans. No ongoing legal issues. Companies under investigation or involved in legal disputes are ineligible. If a company resolves past issues, it can apply for listing after a 2-year cooling off period, provided it complies with all regulatory requirements. Is your company ready to take the leap? Let's see what else is involved. General conditions of IFSCA Listing Regulations 2024. Now let's dig deeper into Chapter 2 of IFSCA Listing Regulations 2024, which sets the mandatory requirements companies must meet before listing their shares on financial instruments in an IFSC. Key conditions include: you must be a public company and comply with both Indian and IFSCA regulations. Disclosure of information. Companies must disclose all material information about their operations, financial condition, and governance practices, including potential risks. Corporate governance. High standards of corporate governance are essential. This includes a board of independent directors, an audit committee, and robust internal controls. Pricing and valuation. Share pricing must comply with fair market valuation principles, ensuring no misleading practices that could harm investors. These conditions are designed to ensure transparency and governance, attracting global investors. Are you ready to meet these standards? Let's keep going. The Foreign Exchange Management Non-Debt Instruments Amendment Rules 2024. Here is another important update. The Foreign Exchange Management Non-Debt Instruments Amendment Rules 2024 make direct listing even easier. This amendment allows companies to issue shares in permissible jurisdictions under clear regulatory guidelines. Key points to note. Companies must issue shares in dematerialized form. That means they have to issue shares electronically to comply with global standards. Pricing guidelines ensure transparency in IPOs and secondary offerings, providing investors with fair valuation. By adhering to these rules, companies can ensure compliance and protection for their investors. Are you seeing how all these pieces fit together? Let's take a look at what's next. Compliance requirements for companies. Once listed, compliance doesn't stop. It's ongoing. Companies must continue to meet strict compliance requirements set by IFSCA listing regulations to maintain transparency and accountability. Key compliance requirements include financial reporting. Companies must submit audited quarterly and annual financial statements, adhering to IFRS, US GAAP, or India AS standards. Material event disclosures. Companies must disclose any significant events such as mergers or changes in leadership that could affect stock performance. Corporate governance. Ongoing governance standards ensure the board remains independent and that proper internal controls are in place. Failing to comply can result in penalties, fines, or even delisting. Compliance is key to fostering investor confidence and protecting